Hi, I'm Gizu Raiji, and I want to talk about debt as a credit for working capital. Debt provides financial credit specifically engineered to support a business's working capital requirements. This mechanism is fundamentally designed to meet the human need for accessible financing that allows businesses to manage day to day operational expenses and maintain liquidity by offering this form of capital. Debt enables users to secure the necessary funds required to cover operating costs and ensure business continuity. Entities and owners who require flexible short-term capital for their operations benefit directly from the service. However, the effectiveness of this credit is subject to certain constraints. It, its utility remains limited by the overall limits set for the credit facility and the specific rules governing payments related to debt and interest transaction. A fixed credit facility limits establishes a clear boundary on the total financial exposure or borrowing capacity available within a system. This concept provides a structure constraint for risk management, ensuring that the underlying financial mechanism remains controlled and predictable. The specific limit set in the context is 700 million. Knowing this maximum amount allows user to determine precisely the extent of credit they can utilize or access. This operational ceiling offers benefit to both the financial institution providing the facility and the individual user who benefits from having defined operational boundary. However, the structure introduces a necessary limitation. If the facility reaches its full capacity of 700 million, subsequent additions cannot be made. This constraint ensures that the system maintains its intended control over risk exposure by preventing further borrowing once the established limit has been utilized. A system allowing accounts to operate at a negative balance up to 700 million provides crucial operational flexibility for users facing unexpected financial pressures. This feature permits the account mechanism to accommodate shortfalls or draw down capital beyond the current positive balance. The underlying principle of this capability is that if an individual is granted this credit facility, their account can be pulled into a deficit with the limit set at minus 700 million. This provision directly addresses the necessity for flexible access to capital, ensuring that operations can continue even when immediate funds are scarce. It enables users to effectively manage cash flow fluctuations by drawing upon available credit lines as needed. Consequently, individuals experiencing temporary cash flow shortages benefit significantly from this ability to adjust their liquidity. However, this functionality is not without boundaries. The negative balance is strictly kept at 700 million, and utilizing this credit requires a subsequent top up to reach zero before any payment can be processed. A user must achieve a specific top up position, bringing the account balance to zero before a payment transaction can be successfully executed within the debt system. This requirement establishes the necessary condition for initiating any payment within the system. The underlying logic dictates that to make a payment, the account must first reach this defined state of being fully topped up and subsequently depleted to zero. The specific procedure serves to ensure accuracy in financial operation. By enforcing this condition, the system guarantees that payments are correctly accounted for and that all necessary balance adjustments are handled appropriately prior to the disbursement of funds. Consequently, user gains the ability to successfully execute their required monthly payments according to the established rules. The direct benefit for the user is the assurance of timely and correct processing of their final obligations. However, this process carries an important limitation. If the account balance is not brought down precisely to zero, the payment process simply cannot proceed. This rule provides a clear boundary, ensuring that all transactions adhere strictly to the system's operational requirements for accurate record keeping and proper fund handling. A specific method exists for accumulating credit or increasing available capital by linking facility usage to periodic revenue streams. This approach suggests that if a user restricts their current utilizations on the facility to a certain level, specifically 500 million, they establish a condition under which growth becomes possible when income from interest is introduced. The logic behind this system is straightforward. By maintaining usage below a defined threshold, future incoming revenues from interest can be applied to increase the credit profile, resulting in an upward growth in the key performance ratio. This structure serves to incentive sustained operation and success for the business, establishing a direct connection between incoming revenue and enhanced credit availability. This design allows users to effectively leverage seasonal or periodic income to boost their working capital funds. Those individuals who receive payments from interest gain an advantage because that income contributes positively towards strengthening their financial reserves. However, this growth mechanism is conditional upon maintaining current usage levels below an implied threshold. This condition places a requirement on the user to adhere to the specified usage limits for the credit accumulation process to function correctly. The confidence level associated with this proposed system is 90%. Establishing a punitive measure for non-compliance serves to enforce adherence to payment obligations. The underlying logic dictates that if a payment is not rendered by the responsible party, a fine will be applied. The structure functions primarily as a deterrent against failure to comply and ensures that financial commitments are met reliably. Such penalties grant the institution the ability to enforce contractual agreements and safeguard its assets effectively. The system creates mutual benefit. The bank gains assurance through enforced compliance, while users are incentivized to submit payments promptly. However, the specific penalty is strictly conditional. The fine is only triggered when a payment obligation has been missed. A procedural requirement exists for financial institutions to be notified when incoming funds consist exclusively of interest. This rule establishes a necessary step in reporting specific types of income to the bank, ensuring that all transactions are properly documented. The reasoning behind this requirement is the need for the bank to accurately assess the source and nature of these incoming funds. Such detailed information is crucial for maintaining precise account management and performing through risk assessment. By receiving this data, financial institutions gain better information for their risk modeling efforts. Furthermore, the user benefits from proper administrative processing when these transactions occur. This capability allows the bank to properly classify every transaction and continuously monitor the overall health of a user account. The requirement is specific, applying only when payments are composed solely of interest, distinguishing this rule from situations involving both principal and interest. This limitation ensures the process remains focused on identifying precisely this particular type of income stream.